Greetings and welcome back to a market closing live stream. This is me, Meet Kevin, and I don't know where I put my phone, but oh well. I will be deleting this live stream after the live stream because I have to do that. But in the meantime, we could do something cool, which is we could freely talk about my PP. Usually we can't do that, but as long as I delete the video after, I can freely talk about my PP. So if you have any questions about my PP, ask away. In the meantime, we'll also be covering earnings. If you also want to learn more, I'm going to put that up. Learn more about my PP ETF at http://longpp.com. There we go. See, it's simple. And if that doesn't work, then just go to mketf.com. Anywho, oh, you can also sign up for trade alerts there now as well. We finally got that going. So we have trade alerts now working. They come out on a daily basis. We're trying to get about before the close of biz. So usually by 5 p.m., which is great. But anyway, so trade alerts and learn more about my PP. There we go. Much better. Look at that. How great. Okay, wonderful. So today we are covering, obviously, some pretty big earnings. We have Apple, Google, and Amazon. The market is somewhat selling down going into the close in anticipation of these earnings. Ironically, that is actually a bullish thing. Now, I say that's bullish because usually when you have runs like this, if they end up sustaining into the close and the volatility index doesn't balance out, let's just say there haven't been that many instances in the last 20 years, actually 30 years, of that ending up signaling good news. In other words, Bloomberg had a piece suggesting there have been 16 times that the volatility index has been higher than the S&P 500 leading into the close. And when it actually closed at those levels in the last 30 years, you ended up having an average negative return over the next week, month, and 6 months going forward. Whereas if you ended up correcting before the close, the VIX came a little bit more in balance, it kind of just went back to a sort of normal market. So in a weird way, that little midday sell down there or near end of day sell down last hour here was probably actually a little bit of a healthy thing. Gives the VIX a little bit of time to catch up a little bit, which is good. You can actually see graphically here, this is what I'm talking about here. This sell down right here really helps relax that measure. So volatility index here sitting up about 4% right now. That's definitely more than what the SPY is up right now. Yeah, SPY is sitting right back at about 1%. Earlier, this was quite different, and it was a little bit actually of a bearish indicator. But now it's gone back to normal. So now what are we looking for? Well, we're obviously looking for Apple. We're looking for Amazon. We're looking for Google. We will be covering those earnings live as they come out. You can see Apple here bouncing off nearly that 122 line we've got down here, bounced off about 124. It's basically been up since then. Hit the bottom right around Jan 6, Jan 9. Sitting at about 149 now, still consistent with a downtrend, still in or just now barely breaking, actually today trying to break the 200-day moving average. I believe the earnings call or the earnings report is either going to break them right back down to maybe 135 or potentially we can confirm a snap above this this 200-day moving average. So we'll keep an eye on Apple. Big thing for Apple is actually going to be the potential for a buyback. Is there potentially going to be a bigger buyback? A lot of folks are suggesting Apple could sort of offset some of the pain of what revenue numbers they might report if they just increase their buyback. So that'll be interesting. We'll see what happens there. Then we've got Goog. Let's go ahead and go to Goog here. Where can I send an email about the courses? You could send that to kevin@meetkevin.com. McKay's handing out coupons if you need them. And a lot of folks are very, very excited. You can also get a lot of folks are just looking for lifetime access to the course member live streams where we do a lot more fundamental analysis. Trying to get some short analysis in there as well so folks can get short that on a regular basis. So I'm working on that again and some other analysis, which is pretty awesome, including real estate and Q&A and that. You could do that one of two ways. You could just go on the membership join button and pay on a monthly fee basis, or you could just get lifetime access enrolling in one of the courses. You pay once and then you never pay again, which is kind of great. When can you trade options on PP? Hopefully soon, probably when we get closer to about $25 million under management, under PP, will you be able to trade options? Remember, PP is the Meet Kevin Pricing Power ETF. And this is, right now we're sitting at, what are we at, like 16 and a half or something like that? Total assets, 16.3 million in assets under management. And so hopefully that that continues to grow to about 25, and then we could request options. So that'll be neat. So we've got Google over here. Let's take a brief look at Google's chart. Google off its lows went all the way down to about 83 bucks, sitting at about 108 right now. Also testing that 200-day moving average. That's two big moving averages we're going to hit, Apple and Google, and they make up a nice little piece of the puzzle of the S&P 500 and the NASDAQ. So fingers crossed for some good moves there. Why can't I buy PP recurring? I would love for you to have PP on a recurring basis, but you know, I don't know. But thank you for the $5. You'd have to send an email to your broker. Sometimes when you have a new ETF, the brokers need to enable the other features on it, and they don't unless they think there's demand for it. So if you send them an email, customer service, whatever it is, and you start asking for it, the more people ask, the better. And it could even just be a few people asking. It's sometimes all it takes. But yeah, finance. It's probably a tough time to grow a finance channel. I'm not trying to discourage you. I'm just being honest here. Like I understand you donated $5 to see my thoughts about making video content. This is a tough time to grow a finance channel. But anyway, hopefully it gets a little easier. I wish you the best. All right, so let's get into the real time. We also have Amazon coming up. There are parts of Amazon that I like. They designed some of their own server chips. We were doing a lot of research into some of the server chips and the server, the coding architectures for x86 versus RISC-V versus ARM, which is also a version of RISC. Some really incredible research into chips this morning. And I can't help myself but feel that Amazon's retail biz a little bit is like a giant anchor for them. I actually prefer the exposure that Etsy has to retail over Amazon, specifically because with Etsy, you end up, and I'd love another buying opportunity on Etsy, but specifically with Etsy, what you get is you don't actually get all of the headache of the logistics. You just get basically money off of the transactions. You're not even having to advertise your own product. When you do, you split. When you advertise Etsy or you advertise products on Etsy, you end up splitting those costs with sellers when they convert. I mean, there's some incredible parts to Etsy's business model. Fantastic business model, and I personally really like the platform. But so we'll see. Apple, Amazon, Google, those are big deals. I'll go through estimates as well in a moment, but let me just see who else we have here. Look for here. Apple, Amazon, Google, Ford. Wait, did they? Yeah, they're after the bell as well. Oh wow, this is gonna be fun. So Apple isn't until 1:30. Unfortunately, they're always the slowbies. I really dislike that every time they do that to us. But it just means I have to sit in this chair a little longer. But that's okay, because after all, that's what I do. And thank you for being here with me. So we're going to have, let's see here. Starbucks reports as well today. Oh, this is going to be fun. So we've got Amazon, Apple, Google, Starbucks. Most of these immediately after the bell. I'm very curious to see what I can start gleaning from Chinese developments from Starbucks. They've added a lot of stores in China, and I am dying to see what they say about China. So Starbucks, big deal for China. Ford, we'll see what they got going on. Let's see here. Ford. You do also have Clorox reporting, Gilead Sciences, Qualcomm. That's going to be another big one. QCOM. So let's see what we've got going on with all. Yeah, QCOM. Good call there in the comments. So, all right. Okay, earnings up, ready to go. So we are about 5 minutes away from the closing bell, and we are now going to check out how things are actually closing. Let's see how the market's moving. We had a little bit of a sell down there towards the end. Oh, it looks like we're actually getting a little bit of a move up into the end, at least on the NASDAQ. Keep in mind that one of the things that can really move the NASDAQ going into the close is end of day purchasing. And end of day purchasing frequently happens by ETFs, like your favorite ETF, PP. And we all hope that PP goes up in the long term and in the short term. You know what? It should just always go up. We always want PP that is up. It's great. And we hope to maximize its performance. Now, Arcimoto down about 5%, potentially walking into the doors of bankruptcy, although apparently that's not stopping. Oh, look at that Qualcomm before the close here, down 2.59%. Apparently that Arcimoto bankruptcy isn't creating that sort of meme movement that you're seeing at companies like Carvana or Bed Bath & Beyond. Yeah, look at that. Qualcomm actually it's been rising sort of with Apple, very similar trend to Apple, but look at that dive into the close. It did not get any kind of recovery into the close right here. It gave up all of that price action in the day and is not coming back. Restoration Hardware, are you serious? 6.1% today. Intel, 3.6. Holy smokes. Lemonade's up 12. Enphase is only up 0.3. Wow, this is interesting. Very, very interesting. Well, we've got about 3 minutes to go before the closing bell. We have, let's listen into a quick preview over here and see what they're talking about with Apple.
For the broader smartphone space, but we do think Apple held up a little bit better.
Why do you think that? Because PC market has been so tough. Is our phones just not related?
It's true. TAM is expected to shrink 10% per AMD this year.
On
total addressable market for PCs.
Yeah, as far as the Mac side of things, especially for Apple, that's going to get hit a little bit tougher because of the extremely difficult comps that they had from a year ago with the buildup on their internally designed M1 chips. I think as far as kind of smartphone units are concerned for Apple specifically, I do think kind of, of course, the buffer on the ASP side of things as they kind of migrated.
All right, we'll see about those average selling prices there. PP is the greatest ETF name ever. Thank you so much. Going higher is somebody who completely does not understand how ETFs work. And it's okay because, well, it's actually very simple. You can't dilute an ETF. There is no such thing as diluting an ETF. I can't issue shares and sell more shares. It's just whatever money comes in is how many shares we have. Whatever money goes out is how many shares we don't. It's very simple. It just represents sort of the way you have to think about ETFs is they're kind of like you have a pie of the companies that are selected in them, and then the pie moves with the price of those companies. There is no dilution. This isn't like a publicly listed company with some form of diluted share ownership. I mean, you could read all the details by going to longpp.com. But apparently you don't have a lot of pricing power or PP interest in your life. So I don't know why we're even here, but it's okay, man. We can still drink coffee together. So cheers to that anyway. Anyway, Beyond Meat is up 19% going into the close over here. You got a lot of the risk plays moving up. Yeah, there are dividends. I think we have because we own Apple, we've got dividend stocks in there. So dividends flow through to you through PP. But it's a dividend is not PP is not a dividend ETF. When PP, yeah, PP doesn't like to dribble out dividends to you. We don't do that. But I mean, obviously, whatever dividends we have, those will pass through. So this is insane. Beyond Meat, 20% today. These are all names, by the way, that in the first hiccup of inflation are just going to get reamed again. But I mean, I have to say it's impressive nonetheless. It gives a lot of liquidity potential, especially to a company like Bed Bath. I mean, they should just be issuing shares. They might not be able to in their bankruptcy proceedings. Affirm, 20%. They should be raising cash. Oh, man. All right, let's listen to Sarah Eisen take us into the closing bell.
If you look at what's working in the Dow, for instance, or what's dragging on the Dow, it's UNH, Boeing, and Caterpillar. What's working is Home Depot, Microsoft, Apple, and 3M. The S&P 500, firm, 1.4%, adding to gains for the week. We're now at 2.6% for the week. Best performing group, Communication Services. I think we have to hit Meta here into the close, surging 23% for its best day off earnings in almost 10 years. And the NASDAQ comp going out with a gain of 3.1%. For the week so far, it's up almost 5%. Unbelievable close for big tech. Next test, Alphabet, Amazon, and Apple all reporting in minutes from now. That's it from me on Closing Bell. Send it now in overtime with Scott.
I hate to say it, but that gives me nightmares of November of 2021, where Sarah Eisen, every single closing bell, that does it, another record high for the S&P or whatever. That didn't last long. Okay, Qualcomm is a miss on forecast. Qualcomm revenue forecast, I'd say midpoint's about 9.1 here. The forecast was 9.58. So that's a miss on the forecast. On Qualcomm, adjusted first quarter revenue, 9.46 bill versus 961 expected. A slight miss there. You've got first quarter adjusted EPS coming in at 237. The consensus was 234. That's a slight beat there. So slight beat on the bottom line, but it looks like on the top line for Q1, we came in soft. Revenue again, 9.46 versus 961. Adjusted EPS 237 versus 235. The forecast coming in pretty soft. Again, about 9.1 at a midpoint for forecast versus 9.58. Then we've got demand and inventory to normalize in the second half. Qualcomm gives lackluster sales forecast. This has been pretty much the MO of the chip sector, and it's creating a lot of opportunities, in my opinion, to buy chips, because you've got, okay, Amazon sees net sales of lower than forecast. Forecast was 125, midpoint is about 123, so slight miss there. Operating income, $0 to $4 billion for Q1. This is bad. The forecast was 3.52. No additional restructurings is what the guidance is assuming. Net sales actually beat, though. Q4 net sales coming in at 149.2 versus the expectation of 145.8. So you got more sales than expected, but that forecast, I don't know what's happening with that Q1 forecast over there. A little weak on the operating income, so maybe there is some kind of restructuring there. But North America net sales beat by $3 billion. You have $93.3 billion of net sales versus the 90 estimate. You've got online net sales of 64.5 versus 65. That's pretty much in line. Subscriptions at 9.19 bill versus the 9 expected. Physical store net sales beat a little bit, 4.96 versus 4.93. We've got EPS of 3 cents, operating margin of 1.8, slightly under the 1.85. So Apple is not out yet. Alphabet just comes out. EPS 105. Google other revenue 8.8 versus 8.14 billion. Google ad revenue 59 versus 60 billion. That's pretty close. That is a miss. YouTube ads. Oh, YouTube ads misses again. 7.96 billion versus 8.27. Google services 67.84 versus 68.9. Slight miss. Number of employees 190,000. Google Cloud revenue coming in at a teeny tiny beat at 7.32 bill versus 7.3. Operating income 18.18. You've got revenue at the top line, 76.05 versus the estimate of 76.5. So we got a miss on the top. We got a slight misses here on revenues. Some people are calling this meets expectations. I see this as a slight miss, especially on those YouTube ads. Miss on those YouTube ads here. You've got Amazon again. Amazon actually beat on sales, leading shares to rise about 3% in the after hours here. But the forecast, especially on operating income, was pretty weak, not very strong at all. Qualcomm actually, see, this is the insanity of the chips market, okay? The Qualcomm numbers were terrible, absolutely terrible. The guide was low. The numbers are just low. They're not giving a promising forecast. But guess what, baby? Shares up. This is one of the reasons I've been actually loading up on chips, because I noticed Samsung reports bad numbers, they go up. And this was when they pre-reported. TSM pre-reports bad numbers, shares go up. A lot of these chip companies are actually coming back into investor attention. Why? Well, because the bad news is getting out of the way. This is probably the bad. So we're waiting for Apple and Starbucks here. Let's just go ahead and see how things are moving. So in after hours, Amazon actually moving down now about 0.3%, although it's fluctuating pretty heavily here. Google's actually up about 1.8%, also fluctuating pretty heavily here. We have, what else do we have? QCOM was the other one. I don't actually hold any of these in PP. I do hold Apple, but Qualcomm's rising, hold a lot of chip makers, and Qualcomm actually rising about 3%. Obviously, a big player in 5G, big player in chips. Okay, so we're waiting for Apple. Starbucks, North America, same-store sales up 10%. Starbucks reaffirms 2023 full-year guidance. International comp sales down 13%, probably China. Oh, yeah, Chinese comp sales down negative 29%. The estimate was 13.3%. You've got U.S. store sales up 10% versus the expectation of 7.29. Net revenue comes in at 8.7 versus 8.75 billion. That's a slight miss. This is a Q1 comp store sales up 5% versus the expectation of 6.79. More Chinese headwinds, not giving updated guidance, just reaffirming. You've got a miss here on comp store sales. You've got a miss on rev, slight miss. Starbucks now sinking about 3.3%. Could actually potentially be an interesting opportunity to maybe, depending on how it moves tomorrow, buy in on Starbucks if you want that reopening potential play on Starbucks. Starbucks down now about 4%, still waiting for Apple. Google shares gain as revenue meets estimates. I saw it as a slight miss, but okay, fine. Semantics doesn't matter. Alphabet sees exit costs related to office space of $500 million. That's because of layoffs, people no longer getting new offices because, well, there are less people working there. Apple numbers not out yet. We are Ford coming out right now. Ford sees adjusted EBITDA of 9 to 11. The estimate was 10.94. That's roughly in line. Ford to pay a supplemental dividend of 65 cents per share. Ford adjusted free cash flow of 2023 of about $6 billion. Ford to report based on 3 new business segments for 2022. Oh, good. So we'll actually get a breakdown of some numbers. That'll be nice. So we're waiting for that. Qualcomm revenue falls 12%. Guidance implies more pain to come this quarter. However, then again, Qualcomm shares rising. Why are Qualcomm shares rising? Because the worst is potentially behind us. Google shares now down about 1.8% in after hours. Amazon shares down about 3.5%. I'm waiting for Apple. Out of the ones that we're looking at today, Apple is the only one that PP owns. Alphabet or the Meet Kevin Pricing Power ETF does not hold Starbucks, Ford, Qualcomm, Amazon, but it does hold Apple. So it'll be a big L, obviously, if Apple tanks. But maybe it's a buy the dip opportunity. I guess it depends how you look at it. Anyway, Alphabet sees, let's see, 2 update segment reporting for AI activities. That's great. And that's just sort of more color into what's happening. And let's see here. Okay, you want the charts? I'll show you the charts. Here you go. Here are the charts for you, sir or ma'am. Here are the charts. You've got Amazon tanking about 3.6%. You've got Qualcomm moving up slightly, though, about 3%, though. We're getting our first red candlestick here on the averaged. You've got Starbucks down about 2.3-ish. Again, looking for an opportunity to potentially buy in there. Amazon, you're dropping here. You've had one hell of a ride up from about $81. So you've got a little drop happening here in the after hours. So we'll see Tesla down about 1.46% in the after hours as well. Some enthusiasm potentially getting temporarily stripped. I don't see it necessarily as a bad thing, though. I see that as a slight opportunity. So we'll see what happens. So let's go ahead and go back to some of the revenue numbers here. And again, we are waiting for Apple. Apple's probably not going to come out for about 22 minutes. Let me see what other insights we can get here. I think Clorox was coming out as well. And then I want to look specifically at some of the numbers and some of the documents here. Let's see. We'll go ahead and pull those up as well. So nothing yet on Clorox. Oh, adjusted EBITDA for Ford coming in at 2.6 billion versus the estimate of 3.45. That's a miss. Their revenue came in higher than expected, though. So you beat on revenue, but you definitely missed on EPS, 51 cents versus 62. So miss there on the bottom line by Ford. Ford's dropping about 2.5% in after hours right now. Google now all of a sudden dropping even harder. You're down about 4.6%, sort of in line with Amazon's drop there. NASDAQ dropping about 1% here in after hours. Qualcomm starting to give up some of its gains, only up about 1.5%. Apple preemptively starting to sink based on some of these earnings numbers here. And let's see here. Okay, we are waiting for Apple numbers. Trying to see if there was anything. Just DeepMind will report. Okay, that's fine. Yeah, so definitely some misses here in multiple areas. Let's go ahead and let's start with Google while we wait for Apple. So Google Investor Relations. And we could share a screen here and see what's going on. Waiting for Apple. So while we wait for Apple, which is probably about 20 minutes out, we can get all the press release for Google. So let's see what we got. Bang this out together, because that's what we do here at the PP, the Meet Kevin Pricing Power ETF. We bang it out. All right. Here we go. Ready to go. Ready for this? Here we go. This is how we roll. This is how we roll around here. All right. Mountain View, California, Alphabet. Okay, who cares? Long-term investments in deep computer science make us extremely well-positioned as AI reaches an inflection point. Yeah, this is trying to like distract away from the current core businesses, I feel like, and stick with the trends and the fads. Google, YouTube subscriptions, Pixel devices. Great, whatever. Let's look at the actual numbers. So what do we have here in your consolidated financials? Well, we do actually have revenue growth. Now, keep in mind, this is a little bit of a confusing chart to look at because 2021 is on the left, 2022 is on the right. What do we have? 76 divided by 75.3 comes out to about a 1% gain in revenue. Losers. I'm just kidding. I like Google. Don't get me wrong. Oh, look, changes in year-over-year revenue. Look at that. They did the math for us. That's very convenient, actually. I don't have to sit here with a calculator and do it. 1%. Change in constant currency. So without the FX impact, 7%. Operating margin dropped 24%. This is the worst out of all of the prior margin reads that we've gotten for operating margin. And we are actually at an operating income that's other income. We are at a net income of $13.6 billion relative to the $20.6. $7 billion of money just disappeared year over year. Looking at the actual segments, they don't give us percentages on these. But that's okay. You can see Google search ad revenue. This is actually the first decline that I've seen over here. 42,604. Last earnings report, we did not have a decline here. We looked at that this morning, I believe, in the course member live stream. And we were still positive on Google search revenue, but that is about a negative 1.6% revenue read there on Google search. YouTube ads tanking again. We have YouTube ads. Take the new number, divide it by the old number, and what do you get? You get negative, 7.8% year over year for the YouTube ad space. No numbers yet on Apple. What do we have here? The Google network. Is that going to be a red flag for Trade Desk? It could be. That's also down about 9%. Lots less advertising spending. Google Cloud. Google Cloud's still moving, though. I'll give them that. Google Cloud coming in with revenue of $7.3 billion. This is actually up 32% from last year. Not bad. Hedging gains. They made $669 million doing some hedging. Hey. Awesome. Good for you guys. So then we've got Google services. Whoa. What is this? Operating income. Yeah, the operating income on Google services here. What happened, man? Big drop there in Google services. Google services dropping quite a bit. I mean, you're sitting here at 21 bill. 21.1 is the new number divided by 25.9. Google, look at that. That's down about 18.5%. Yikes. Minus 18.5% on the Google services number here. Yikes. Hedge TikTok. Yikes. Okay. Corporate costs unallocated. Corporate costs operating income. What's corporate costs? Unallocated. Like SG&A that's not allocated to a specific segment. I understand. Okay, yeah. Well, they've certainly shrunk that. That's nice. That's fallen in half. Okay, so how balance sheet? I'm not terribly worried about their balance sheet. We've got current liabilities. I'll take all of these of about 64 bill. We've got long-term debt of only about 14.8. That's not bad. Lease liabilities doesn't so much matter. We've got taxes due, non-current. Okay, so we're about 20 bill here. They've got cash. Oh gosh, they've got cash like crazy. They're so well capitalized. They've got 140 billion dollars. Sorry, sorry. That was last year. My bad. They've got about 113 billion dollars here. And probably about that takes us up a little bit, 85 plus income tax, 95. You have about 95 billion in total liabilities that I'm really looking at, not considering leases. They've got plenty of cash, plenty of marketables. They're not going anywhere in terms of cash. They're well capitalized at Google. Now, operating activities in terms of cash flow for the quarter end and the year ended, we still got some really nice cash flow here. I mean, you've got free cash flow in excess of $15 billion in the quarter. You've got free cash flow in excess of $60 billion. $60 billion in 2022. That is insane. I mean, the amount of cash flow this company has is really, really good. So great amount of cash flow. The problem is everything's just slowing down, right? The growth is going away from big tech. Unfortunately, we've got a big bunch of negatives over here. And that's one of the reasons you're seeing some pain here, in addition to a not so fantastic forecast either. Revenue missing in a few different places. Let me look at the forecast here. You are looking at about an estimate of a $5.72 EPS by the end of the year. Google right now trading for, what are we at, about 105? Let's see here. Google's trading for 104.4 divided by 5.72. Google right now is sitting at about an 18 times multiple, 18.2 times PE. But what EPS growth? Well, EPS growth projections, at least. What is Wall Street thinking for EPS growth? Let's see if we can find that out here. Stand by. We are looking at maybe 5.72 in 2023, maybe up to 676 next year. Okay, well, we're looking at about 18% EPS growth going forward. So about 18%. So that really puts you at roughly, because right now we see EPS declining for 2022. So that's about a 1 peg if you ignore declines in 2022. So it gives you a little bit of a valuation idea. If you sort of put 22 behind you, you're possibly at the bottom for declines. Let me look at the quarterly estimates. And I can tell you on the quarterly estimate, we do expect to go positive again to about 1.5% in the first quarter, and then up to 18% thereafter. So we'll see. Very, very good. Very good. We will see what happens. 18 times. That's right. That is Google. Google down again about 4.8% right now. Amazon also down about 4.9%. You do have Ford Motor Company now down 6.6% in the after hours, getting reamed. Tesla down about 1.1% in the after hours, 1.2%. Intel's down about 0.75% as everybody is on standby for Apple. Apple earnings coming out in about 11 minutes. Enough with the German accent. Hey, you stop that, Mikey. Anyway, all right, now let's go ahead and go to, that was Alphabet. Let's go ahead and get Amazon numbers. Amazon Investor Relations. And we've already gone through the Amazon earnings, so just rewind if you kind of want to listen to me reading out the actual numbers. I don't want to repeat it over and over again, but let's go ahead and actually get into the Amazon release. This is how we get work done, baby. Yeah, QCOM, we covered QCOM. Maybe, just maybe. We'll actually go look at the QCOM Investor Relations report as well if it happens before Apple actually comes out. But first, we're going to look at Amazon. All right, I don't really care about the highlights for right now. I just want to get to the statements. That's what I want. That's where I'm going to start with Amazon. Okay, another one of these reverse left to right readers. I don't know why they do this. The accountants really need to move the columns. Oh, God, it's so annoying. Okay, net product sales. Ooh, negative. There's the revenue recession. 71416. We are negative 1.2% on net product sales year over year with all the inflation. Then you have net services sales. Ooh, I actually like the services sale growth. Let's see here, 65996. We're looking at 19.2%. It's okay. Oops. It's actually right 19.2% correctly. There we go. That's not bad. It's certainly slowed down. Let me see how much it slowed down. We went to 271 for the 12 months ended. And if I divide that by the old number of 228, we were sitting at about the same place. Actually, we were a little lower, 18.9%. That's really interesting. So you actually have had an acceleration in service sales. That's great. That's actually good because those are obviously a higher margin. Note, they don't give it, like, it's very difficult to calculate the margins on this page. So we'll fast forward and we'll go to some of the different pages where they actually give us the margins. And that's because they lump into costs of sales, product and service sales together, but then they separate out fulfillment. It is the most confusing thing when it comes to calculating margin. It's crazy. Get about a 20% there increase in sales and marketing. Technology and content. This is actually where they spend a lot of their money on producing videos for Amazon Prime. And that division's up about 36% to get that content machine going. Wow. 36% increase right there. G&A, relatively small, but in terms of a bottom line, actually pretty large because bottom line just ain't that big. 3.3 billion divided by 2525 is about a 32% increase in G&A right here. Marketing about 20%. Got interest income. Where are they getting all this interest income from? But they're expending it as well. Maybe treasuries. Earnings per share coming in at just 3 cents. My gosh, that's like net income, $278 million. That's it? Dude, that's low. That's a plummet. I mean, you're negative. You're actually negative for the last 12 months on Amazon. Holy smokes. Wow, that is remarkable. Okay, well, that's very interesting. So what do we have over here? You've got, let's see, 12 months ended December 31. Yep, there's that operating loss. Let's look at segments, though. I want to see Amazon Web Services. Again, while we're waiting for Apple here, Amazon Web Services. What do we have for net sales? We have 21.3, and we have, let's see, 21.3 divided by 17.78 is 19.8% growth on AWS. It's actually good. We're still seeing growth over here. How does that compare to the year? Why do you compare to the year, Kevin? Oh, well, thanks for asking. You compare to the year so you can see if the growth rate is changing. And what you can actually see is you actually do see a changing growth rate. See, look at that. The growth rate was 28.6%. Now you're at 19.8%. So you've got a slowing segment here. And then what about margin? 16.1 divided by 21.3. Well, you are at a cost ratio of about 75.6 here. How has that cost move? 57.255 divided by 80.096 equals. Ooh, yeah, the costs have definitely gone up. You were at about 71.4% over here. So you've definitely seen costs rise and AWS growth slow. It's worth writing that as a little sort of takeaway note while we wait for Apple here. So we're going to write that down. AWS slowed growth to under 20% and margin compressed about 420 basis. Of course it did. 420 basis points. I ain't making the number up. You can see it right there. It's 420 basis points. So, okay, so we've got margin compression. We've got an AWS slowdown, potentially a little bit of a lack of PP over there. We really like our PP around here, okay? We're big fans of pricing power. We're looking for companies with big pricing power. We want big PP. That's what we want to invest in. Now, keep in mind, we want to invest in companies with high free cash flow. The reason I like to do that, at least, not personal financial advice for you, is because there's less of a likelihood of them needing to dump a bunch of shares on you just to survive a recessionary environment. Right now, Google down about 5.5%, Amazon down about 5.3%, but you could still take advantage of that beautiful coupon code expiring at 11:59 Pacific time tomorrow. Email McKay or Kevin at meetkevin.com if you have any questions about a custom bundle code. That will be our last coupon code, and you're guaranteed to be getting the best price. Anyway, we're waiting for Apple right now. In that, you'll also be able to join my course member live streams where we do this more regularly. Let's go ahead and get some more numbers here, though. So let's look at their cash flow. Amazon cash flows. Oh, wow. This is a disaster. How do I look at this? Okay, operating cash flow trail. Okay, this is a consolidated statement. This is not a GAAP statement. Okay, whatever. I'll look at their consolidated for a moment. Operating cash flow trailing 12 sitting about 46. But this is not free cash flow, because if we look at plant, property, and equipment, you're actually negative free cash flow here. All you have to do is subtract the operating cash flow or plant, property, and equipment from operating cash flow. And if you get a negative number, you have a negative free cash flow. Oh, look at that. There it says free cash flow. Oh, wow. They are basically always negative free cash flow because they spend lots and lots of money. Keep in mind, the nice thing about free cash flow and looking at cash flow is it removes things like write-downs on stock losses, investment losses. It removes stock-based compensation, right? You're basically removing the non actual cash transactions. And we want to see cashola in a recession. Lots and lots of cashola. In Germany, we call this Kohle. Zeig mir die Kohle. Ich brauche mehr Kohle. Anyway. Online store sales, we got that growth here of 2%. That's year over year. But the year over year online store, wait a second, that's excluding foreign exchange, right? Because we're negative otherwise if you include the foreign exchange, the FX. They actually break these items down here. We've got cost of sales, fulfillment, S&M, great. Let's see, while we wait for Apple here, what we have on the headlines. We have a little bit more. Net sales, we have an increase of 9% in the fourth quarter compared with the fourth quarter of last year. Is that what we saw? An increase of 9%? That's not what I saw. Okay. That's the average net sales, right? Because they had a loss of product sales, went down 1.2%, but total service sales went up 19%. But remember, AWS is slowing down. And to me, that's a red flag because that's where the profit is, folks. AWS is what makes the money. But they don't even make that much money. That's the problem. I think that's one of the big issues that you end up having with Amazon is the very nominal net income here. You do have another income. You have another expense here of about 3.4 bill. Is that another Rivian write down? Let me see here. Oh yeah, probably. That makes sense. Oh, yep. Took about a $2.3 billion hit from Rivian. They've regularly been losing money on that one. I wouldn't be surprised if they end up going BK, quite frankly. Bloomberg puts them at about a 35% chance of BK. A lot of people get mad at me when I say that, and they're like, but Kevin, Amazon backs Rivian. Yeah, and Amazon ain't dumb. They're not going to throw money into a company that's going to go bankrupt any more than they already have. Now, if they can fund them a little bit and actually feed them out of bankruptcy, maybe it's worth it. But that is a separate decision you make. If you've ever been in a business class, you understand the concept of the sunk cost fallacy. Somebody here says, Deutsch flow wunderbar. Ah, yes, thank you. Schönen Abend an alle. Oh, here we've got the Lorenz N is wishing you all a very good evening. That's because they're in Germany, and I don't know, it's probably 9 + 1. It's like 10:30 at night over there. And you're listening to the Apple earnings call. You know what? Cheers. Apple zu den Mond. Anyway. All right. So far, these earnings just aren't great. So brace for impact on Apple because Google's down 4%. You've got the NASDAQ down about 0.1%. You've got Qualcomm still barely positive, but Amazon's down 3.5. Starbucks is down 3.5. They're recovering slightly. Ford's down 6.49%. I mean, these earnings weren't that great. It is 10:30 over there. Zumond. Oh, is that how you say it? All right. Well, it's zu dem. Dem. Oh, dem. Okay. All right. Well, fine. The conjugations in German are something else. Anyway, we should have Apple here in about 30 seconds. So, drum roll for the Apple. Zum Mond? Yeah. All right. Anyway, Google reported already. Just rewind the video. Everybody's going to correct my German now. But we do have someone here from Österreich. Grüße aus dem kalten Österreich. That means greetings from the cold Austria. All right. Here we go. EG. Okay, Apple. Oh my God, there's so many numbers. What the hell? How am I supposed to read it? Dude. Okay, Apple EPS missed 188 versus 194 on the EPS. Revenue came in at 117. Amazon returned over 25 billion to shareholders in Q1. Q1 revenue misses. Apple iPad revenue, 9.4 iPad revenue. It's probably some missed revenue there from the summer versus 7.76 expected. Products revenue comes in at 96.3 versus 98.98. Mac revenue big miss on Mac, 7.74 versus 9.72. Womp, womp, womp. Wearables comes in at a miss, 13.48 versus 15.32. Greater China beats 23.9 versus 21.8. Services revenue coming in at 20.77 versus 20.47 for services. Okay. Apple tanking into the close, 4.5% down. It's either a buy the dip or their PP just got really small. I'm not sure, but we'll find out. We don't do any trades in after hours. That's for sure. Apple has Q1 revenue again, 117.15 versus 121.14. You have iPhone revenue miss 65.78 versus 68.3. Multiple misses here. Wearables, Macs, and what was the other one? Wearables, Macs, and iPhones miss. However, iPad beats. So a beat on iPad, everything else misses. Apple now bragging about having over 2 billion active devices as part of the installed base. Apple complaining about the difficult macro environment, supply chain constraints still affecting Apple apparently. Okay, these are so far are all just not great earnings. They're all a little worse. Apple's revenue growth streak snapped after supply chain woes. Apple sales misses estimate in face of supply chain numbers. Again, the Apple iPhone revenue also misses. iPhone, Macs, wearables, miss. Total revenue, miss. EPS, miss. Everything, miss. Womp, womp, womp. So let's see if we can actually get into their filings here. Let's see what we can get. Read more. The earnings calls are obviously going to be pretty critical. Let's get their consolidated financials and see what we've got going on in the numbers. Apple sales dropped 5%. Largest quarterly revenue decline since 2016. Holy moly smokers. It's a painful result for Apple. Apple looking at 104.4 divided by 96.3. Product sale. Oh, that's no wait. I divided the wrong way. Hold on, stand by. 96.388 divided by 104.429. You're sitting at a 7.7% decline in products, baby. Minus 7.7. Services actually popping up a little bit. 19.5. We're looking at about a 6.5% gain in services. Let's look at margin. Cost of product rev was 64,309 divided by 104,429. You're looking at about a 61.5% cost of goods sold for products in 2022. 3 months ended. 60,765 divided by 96388. You're looking at about a 63% cost of goods sold last year. So you've got a little bit greater of a cost. You've got about 150 basis point margin decline on gross profit. You've got sales plummeting about 7.7%. Total sales, if you add services in, not as bad. 123,945. The new number is 117,145. You're looking at a decline of about 5.5%. On total numbers here, minus 5.5%. We have earnings per share coming in at obviously a decline. Earnings per share right here, looking at 189, 188 on the diluted. That is a decline of divided by 210. You're looking at about a decline of about 10.5% on Apple's EPS, minus 10.5%. on diluted EPS. Apple sales shrink as COVID disruptions in China slow production. Apple now down about 4.2%. It is also dragging down all, apparently other stocks are getting drugged down now as well. Tesla down about 2.5%. Remember, we have the jobs data tomorrow. We're looking at somewhere around 5:30 a.m. We're going to get the jobs data. Trade Desk was up about 9% on the day, but in after hours now it's down about 3%. Bitcoin not moving terribly much, sitting at about 23.7. So we could see a recovery by the time market opens tomorrow, which of course I'll be live for the pre-market. Look forward to seeing you there since I'm streaming every morning now. We have on the cash flow statement. Let's see if Apple still has any cash flows, or have they just lost their entire PP? I don't know, but right now it's starting to feel like Apple's got a little bit of a short PP, but I don't know. It could maybe we could just get away with blaming China. And if we can get away with blaming China and things are getting better in China, then maybe we can get away from the small PP now that China's holding us back, and maybe they can actually help us get that pricing power up. So we'll see. Now, we had an increase in inventory here of about $1.8 billion in the third quarter. We have cash generated by operating activities, $34 billion of cash flow by this company in one quarter, folks. Don't tell me Apple is not a great company. When you can generate $34 billion of cash in one quarter, that's insane. Now, Apple did spend some of that buying some treasuries. They also let some treasuries roll off. What do we have here? Look at this. This will calculate our free cash flow for us, bringing us to about a $30 billion free cash flow in one quarter. They don't even have to do like last 6 months or last 9 months like many companies do. That's incredible. Massive amount of stock repurchasing here, about 19.4 bill. Unfortunately, you didn't get a larger buildup of this. You do have Carvana sinking now in after hours, as I think some momentum is turning a little negative. Apple now only down about 3.3%. A little bit of a recovery here on Apple stock. As I think the markets are sort of digesting that, hey, look, if this ended up being a supply disruption and it's maybe a short-term issue, maybe Apple can do what it pulled off last time, which remember, wearables, Macs, and iPhones missed, but iPads beat. But remember, we had iPad supply chain disruptions in the summer. So now people got to go buy their iPads, okay? By the way, if I may recommend an iPad, because yes, I pretty much use all Apple stuff, although I did recently buy a Google Pixel, and I have to say it's not bad. You know, it's a very different ecosystem. I can't airdrop and stuff, so I kind of feel locked into Apple a little bit, but I do have this Google Pixel over here that I kind of look at every so often. But anyway, when it comes to iPads, you know, if you're traveling, I'm just going to quickly do it for what it's worth. If you're traveling, okay, the little one, love it. The little guy, delicious if you're traveling because it's light. Okay, they don't even sell the keyboard case for it because it's light, it's small, it's great. You can make phone calls on it, but it's actually really nice for like reading to have this versus like an iPhone. I'm kind of tired of that. But personally, if you're an office kind of person, there's only one way to go. I bought all my employees a brand new one of these suckers, and they are freaking awesome right here, baby. iPad Pro, spend as much money as you can with the exception of the storage. You don't have to max that out. And this keyboard is amazing. However, it will drain your battery, the phantom drain on that battery or that keyboard. I don't know why it's so bad, but it's pretty bad. McKay just sent me a message and reminded me that he is standing by at his computer responding to emails right now for people interested in joining the courses. If you've got any kind of questions or you've got a complaint, why are you not joining the courses? Maybe you don't know what's right for you. McKay is ready to help you out. So just send an email to kevin@meetkevin.com. Okay, let's get back into these Apple cash flow numbers here. So we've repurchased stock, we've repaid some debt. Although, how much debt does Apple actually have? Oh, look, the answer is right here. Holy smokes. Term debt, $99.6 billion. Other non-current liabilities, we got $152 billion of long-term debt. We've got payables and short-term liabilities of somewhere around, I'll just give them all of this, 137. But what do we got in terms of cash? Actually, not as much cash as we used to have sitting around here. Only about $50 billion of cash. They've got plenty of cash flows. They've got plenty of money to pay for their current liabilities. But they need to get to selling actually over here, because look at this. You know, you've only got about 50 bill of cash. Sure, you've got receivables and inventory is going to go into cash flow. And yes, you've got treasuries, but come on, folks, you got bills to pay here. You got almost $120 billion of bills to pay. Deferred revenue is obviously not a bill to pay, but you know, they're not as cash flush as they used to be. Not as cash flush as they used to be. On Thursday, the iPhone maker announced its first quarterly revenue decline in 4 years as manufacturing disruptions in China curbed its ability to deliver premium iPhones. For the holiday quarter ending in December, Apple had revenue of $117.2 billion, down 5% from the same quarter a year ago, missing analyst estimates. Okay. Apple Tim Cook said that in addition to manufacturing challenges, the economic climate also played a role in the company's results. We estimated that we would have grown on the iPhone absent supply chain constraints. Oh, that's actually good to know, because we did miss on the iPhone as well over here. And so Tim Cook suggests growth had it not been for supply issues. Now, I'm going to be doing a summary here in just a moment. So if you want to stick around, I'll just give you sort of a quick overview summary here of everything. I'm not going to read every single number back because that gets a little boring. So with supply chains largely normalized, we now believe Apple is entering a period of slower demand due to macro factors, says a senior researcher at the investment bank Cohen. Apple now has 2 billion devices. Okay, interesting. I view layoffs as a last resort kind of thing. You can never say never. We want to manage costs in other ways to the degrees that we can. They've kind of been dodging the idea of layoffs for quite a while. So quite interesting. Okay. For keyboard, turn off the backlight. Greatly reduces battery drain. Oh, okay. All right. Well, good to know. All right. Let's do. Okay. Kevin never says whether the coupon codes expire Eastern or Pacific. Pacific. My time, baby. My time. 11:59 p.m. So iPhone sales are. Yeah. I mean, iPhone's the big puppy here for Apple. You're actually right to observe that. Look at that. Apple is the iPhone is basically more than the other segments combined. So we want to look at the left column here. So if you just look at the left column right here, this is 2022. And yeah, I mean, you add up everything else. What is that? 33, 42, 50. Yeah, you're still another 15 bill over on iPhones. iPhones. That's where it all is. Remember when Steve Jobs believed in no debt? I remember when Steve Jobs was around. It's been a while. It's kind of sad. But yes, big cash heaps they enjoyed. Okay, so let's do a little bit of a recap of all this insanity that we have. And let's see what we got here. I'll try to recap this as best as I can, although I don't know how great I'm going to do it. I'll do my best. Stand by. Where is what I want to show? I don't know where to put it. Whatever. All right, whatever. Well, we just got a crap load of earnings, and unfortunately, pretty much all of them were worse than expected. We got Apple, we got Google, we got Ford, which plummeted the most. We got Qualcomm, we got Starbucks, we got Amazon, and we've got some problems to talk about. First, Starbucks is one where obviously we would expect that revenues in China would be the weakest, and indeed, the Starbucks revenues were the worst in China. Now, I personally think, and this is my way of trying to get exposure to China, and I have not invested in Starbucks yet personally, but I do think that there could be a potential to invest in Starbucks because they have substantially increased the number of store exposure they have in China relative to 2019. I feel like during the pandemic, Starbucks basically just flew to China and opened as many Starbucks as they could while everyone was on lockdown. Now, that's really interesting because you would not expect to see any of that revenue really yet in Q4 since they basically just started unlocking the economy at the end of Q4. So I wouldn't be surprised to actually start seeing Starbucks revenues come in substantially higher in the future, led by China. look, comp store sales in the United States are still kicking it. You're up, killing it. They're up 10% versus about the 9.2 that was expected. And the numbers actually did very, very well overall for the United States. But again, China comp sales were down negative 27% versus the 13.3% expected. US comp store sales beat, but net revenue in Starbucks because of China did miss slightly, coming in at just $8.7 billion. Now, I personally think Starbucks could be a play you want to pay attention to into the future. And they've already recovered off their bottoms, but I still think long term there could be some really big growth and potentially pricing power at Starbucks. After all, who can sell you Starbucks for the price that Starbucks, or who can sell you coffee for what Starbucks sells it for? It's incredible. Obviously, a lot of coffee shops sell very overpriced coffee, but look at their margins, pay attention to the company. It's something to consider. I think that Chinese element is going to be ignored for quite a while. And all of a sudden, Wall Street and markets are going to go, oh my gosh, where did all this come from? Oh, that's right. We forgot. Starbucks spent the entire basically pandemic just building stores in China. It's remarkable how many stores they've added in just the last few years here in Starbucks. So pay attention to that. You can see their exact store counts on their annual releases. Now, if you look at Amazon, Amazon did, well, they had a total increase in net sales. They beat on net sales, okay? We got 149.2 versus the 145 estimated. But when we actually looked at the details, because the devil is in the details, we saw some numbers that weren't actually that great. And this is a problem because Amazon, look, they're in a very expensive business. They're in a business of fulfilling goods and services. They're in a business of creating content for all of y'all, which I'll tell you, creating content for all of y'all is very, very difficult. Y'all don't like something, you out of here, okay? And Amazon feels the same thing on Amazon Prime, and it's very expensive. But anyway, take a look at some of these consolidated numbers here. You're on product sales down 1.2% year over year. Service sales down, whoops, lost it there for a second. There we go. Service sales down service sales up 19.2%. So you get sort of that blended increase in revenue, really pushed up by AWS, right? Services sales. AWS did grow, but it's unfortunately growing slower than it used to. If you look over here at the beginning of the year, the AWS segment was growing at almost a 30% clip at 28.6%. Now it's only growing at 19.8%. That represents margin, and margin has compressed. So you've got growth slowing to under 20% in the server business, which is a higher margin business. But on top of that, you also saw margin compress. You had costs of goods sold of about 71.4% last year. Now costs of goods sold for servers have gone up to 75.6%. That leaves you with a 420 basis point compression in margin. So in other words, server and the profitable segment is slowing. Server growth is slowing, and operating expenses are widening. Not so ideal for Amazon, and that's leading Amazon to fall about 4% in after hours. We did have a technology and content boost of about 36%, G&A boost of about 32%, and another about $2.4 billion hit because of Rivian. Rivian, again, costing Amazon a lot of money. I personally maintain my belief that there's a high likelihood, Bloomberg estimating 35%. Personally, I'm estimating a little higher likelihood of Rivian potentially going bankrupt. Now, a lot of people are like, but Kevin, Rivian's going to get bailed out by Amazon. Not necessarily. Just because Amazon's lost a lot of money on Rivian doesn't mean that if it's a bad idea to invest in Rivian, Amazon's actually going to choose to fulfill that bad idea and invest in Rivian. In other words, if the dog's going to die, you kind of got to give it its peace and let it pass away, okay? It doesn't mean you got to keep throwing money at it, okay, to try to squeeze another week out of it. It's just, it starts getting inhumane at some point. Anyway, Ford also had disastrous numbers. The Ford numbers, not so great. Neither were the expected earnings, by the way, just to wrap up on Amazon. The Q1 expected actual net was somewhere between 0 to 3.7. The guide was like 3.9. So the fact that the midpoint is, basically closer to 0, not great. So a little bit disappointing there on the forecast. Ford, you had cost headwinds of an additional about $5 billion expected for 2023. They're calling car prices flattish with more incentives this year. Now, this reiterates what we saw with GM. General Motors told us the other day that, look, we think prices are good where they are, but we're going to give people a lot more discounts to buy our cars, which is basically doing a price cut without doing a price cut, right? All you're basically saying is we're going to keep the MSRP here and we're going to let dealers negotiate more. That's all they're basically saying. So in other words, prices are coming down. That's because remember, Ford and GM, they still have the dealership model. So they keep prices stable and then they just discount more. At one point, Ford was down as much as 9% in the post market, though it seems to be settling down by about 6% down. Their adjusted EBITDA is expected for the next year to be sitting at 9 to 11 billion. The estimate was right about in line with that. They're paying an additional dividend of about 65 cents. And they've got adjusted free cash flow estimates of about $6 billion for next year. So you're still in a positive free cash flow territory for Ford. Qualcomm, not that great. They see weakness for the handset market. That's like cell phones, right? Like iPhones, sadly. Qualcomm's still doing a lot of the 5G chips for Apple, even though eventually Apple wants to bring this stuff in-house. They haven't fully transitioned away from Qualcomm yet. Qualcomm still warning about potentially more weakness coming to the cell phone market. Initially, Qualcomm actually rose after bad earnings. This is because a lot of chip companies are suffering, and they've given such bad guidance that the fact that now we're getting Q4 earnings out of the way is kind of seen as a relief that some of the bad news is over. Their earnings per share came in at about $1.98, adjusted EPS 237. Their forecasts were kind of roughly in line with estimates. You had EPS guidance of about $1.53 to $1.73 for Qualcomm, and automotive revenue rising and an EPS beat in this quarter for Qualcomm. But I think what was more interesting was actually what was going on at Google. Now, Google, big boy, and then, of course, we'll get to Apple. So Google was another one where, well, the earnings just weren't as great as we were hoping for Google. We were hoping for some better numbers. Got okay numbers, but again, when you looked at sort of the devil of the details, they just weren't fantastic. Here is the devil of the details. Search revenues declined 1.6%. YouTube ads, a second quarter in a row of declines, unfortunately, down 7.8%. Probably not the best news for one of my favorite players, Trade Desk. You're seeing this shrinkage in advertising, whether it's in Google search down 1.6% or YouTube down 7.8%. Given that I'm also posting a lot of my videos on YouTube, probably also not the best thing, but oh well, it is what it is. Network revenue down about 9%. You're sitting at about an 18.2% X PE ratio for Google right now going into 2023 for the year end. If you peg their growth at about 18%, you're looking at about paying about one peg. That's assuming they're going to get back to growth, which is generally expected for most of these companies within the next quarter or two. Google services actually down 18.5%. So some big hits over here. You do have Google Cloud, though, up 32%. So not bad for Google Cloud, but a little rough on some of these revenue numbers here. And their operating margin shrinking about 200 basis points. You've got plenty of cash at Google. So you don't really have any kind of capitalization issue. And when you look at cash flows for Google, you're still printing cash. You've got about over $15 billion of free cash flow in the quarter. You've got about $60 billion of free cash flow for the year. So you really have a company where, yes, revenue is shrinking. Yes, we've gone negative on revenue compared to those crazy comps from last year. But you still got an insane amount of cash flow. You've got a phenomenal company here. I don't invest in Google right now, but it's something I would consider investing in, especially if we get a nice little treat of a dip. I'd probably be more inclined to bet on Google over Amazon because I personally believe the retail business of Amazon is going to be a giant anchor for Amazon into the future. I'm not a big fan of investing in companies with giant anchors. I'm a big fan of investing in companies with giant PP. That's pricing power, okay? I like giant PP. It's very good. It's very healthy. It's very important to have pricing power. But it's going to take a little bit of time to convince me that ads from Google have pricing power again. The nice thing with connected TV advertising from Trade Desk is it's a small and growing market in the advertising space, so it should be easier to beat. But these numbers aren't looking great for the setup potential for the next earnings report on Trade Desk. Now, the next one is Apple. Now, generally, Apple has substantial pricing power, but the problem with Apple is we had a miss. We had lots of misses, okay? We actually missed on, I'll give you the short scoop. We missed on wearables, we missed on Macs, we missed on iPhones. And we did beat on iPads, but unfortunately, that doesn't offset the decline in iPhones. Now, Tim Cook tells us that had it not been for supply chain disruptions, they would have actually have been able to deliver more iPhones and show iPhone growth. But we didn't see that. Instead, what did we get? We got a decline in sales in China. We got a decline in sales in Japan, a decline in the rest of the APAC region. We got a decline in Europe, and we got a decline in Europe. In other words, sales declining as a comp purpose everywhere. And this was one of the first Apple declines since about 2016. Products declined 7.7%, products and services down 5.5%, on top of another 150 basis point squeeze on margin. Apple very excited, though, that they've got about 2 billion active devices right now, and they are hoping to get back to growth here in 2023, as many companies are. We're getting this over and over and over again at companies. They're like, second half, Kevin, focus on the second half, second half, second half, second half. Everybody wants to talk about the second half being a lot better, but so far it seems like we got to get the bad earnings out of the way from Q4 first. Now, there are two things that can happen here. We could see some of the euphoria of today relax, which is probably honestly a healthy thing, since quite frankly, let's be real, even a 3% decline, which we're seeing right now on Amazon or Starbucks or Apple, not a big deal relative to the price increases that we've just seen over the last few days. Apple, after all, was up 3.71% today. So even though Apple missed, you're literally just going back to yesterday's pricing. Like, who cares? Who cares? It's not that big of a deal. Google was up 7% today. Okay, it's down 3.75% in after hours. Who cares? $60 billion of free cash flow. The company's killing it with money. Yes, it is going to be difficult to compare it to 2021, and that's what Q4 does. So the goal is, how can you look forward? And which companies do you think are going to have the greatest pricing power going into the middle of 2023, when we finally expect to get some of these companies back to growth? While I don't invest in Starbucks, I'm very tempted to look at Starbucks a little closer for that potential Chinese exposure. I'm also curious to see how Apple's going to reposition themselves and how quickly we think some of those supply chain issues could go away. Because just because you have supply chain issues doesn't mean you don't have pricing power. It means people want your product, but you can't deliver. We'll have to pay attention to the earnings calls for details on that. What concerns me more for Amazon is that compression in the high margin business, which is the server business, right? Content generation, Amazon Prime is a loss leader, really, in my opinion. I don't think you're really making big money there yet. We could also see that in the numbers. We know Amazon's not making money on selling you goods and service or basic, stuff at Amazon.com. That seems to be another money loser. So they're really trying to get AWS going as a cash cow, but so far they're cash flow negative. So I'm not the biggest fan of investing in cash flow negative companies, and Amazon is a big boy when it comes to negative cash flow. Unfortunately, consistently representing negative cash flow. You can actually see that on screen here. Q4 2022, negative cash flow, $11.5 billion. Last quarter, negative 19.6. The quarter before that, negative 23. The quarter before that, negative 18. So you kind of get the idea there, okay? We're not generating cash flow at Amazon. Whereas when you look at Google, you're looking at 91 minus 31. You're looking at about $60 billion for the year. This is incredible. But wait, if I add that together for 2022, oh my gosh, that's embarrassing. Hold on a sec. If I add together 18 plus 23 plus 19 plus 11 and add a couple there because I rounded a bit, you're about negative 70. Okay, as much as Google made in free cash flow, Amazon lost more of. That's insane. Like if Google took all of their free cash flow and gave it to Amazon in 2022, Amazon would have still managed to lose cash. That's insane. That's actually really insane. Now, if we look at the Apple cash flow, also look at that nice $30 billion of free cash flow. And that, folks, is just for the quarter. of the fourth quarter. So Apple, massive free cash flow. Yes, you've got a little bit of a squeeze on margin and supply. So again, we've got to pay attention. What is that supply going to improve? Does Apple still have a big PP, a big set of pricing power or not? TBD. So these are things we're going to want to pay attention to. Ford expecting to see discounting. Not a surprise the stock is selling off on that news. Qualcomm's been one of those stocks that's been having a little bit of a rough time really coming up. I'm curious to see what we hear in the earnings call, though, if it's anything like what we're seeing from Samsung, Taiwan Semiconductors, ASML, or really anyone in the chip sector, NVIDIA, AMD, it's probably second half of 2023 is when folks really expect chips to launch. So we'll see. It's an interesting set of earnings today, and hopefully you appreciated this a breakdown on earnings. Make sure to check out the programs on Building Your Wealth down below. Learn all about big PP, big pricing power. You've got someone over here that says, I cringe every time he says PP. Well, I'm sorry. I keep talking about PP, okay? PP is very important to talk about. We have to build PP. You have to grow it. It's the most important thing you could do in investing. Hanes underwear for PP? Yeah, maybe. Anyway, big fan of pricing power. Big fan. Thank you so much for watching. Free cash flow, 45 billion annualized for Google. Doug, that's terrible. Oh, you what? Hold on. We got a hater. 40 billion. There's no annualizing. It's $40 billion of free cash flow. Yeah. Free cash flow for Google, $40 billion. I think you're being sarcastic. You're being facetious, aren't you? You're predicting forward. Oh, what you're doing is you're taking this quarter. Is that what you're doing? Let me see. Free cash flow. No, that's not right either. 23.6 minus 7.6, 16 times 4, 64 bill. A little more. Anyway, cheers, my friends. We'll see you in the next one. Goodbye. And I wish you